Currently in a meeting and will be here shortly. And in the interest of time, I'll proceed by opening the hearing, welcoming our witness, and making my opening statement. Last Thursday, Secretary Paulson, Chairman Bernanke, and the Chairman of the SEC, Chris Cox, came to the Capitol to brief the leadership of the Congress on the financial crisis facing our country and to ask for a swift, robust response by Congress. On Saturday, they followed up that meeting with a legislative proposal, or at least a skeletal outline, the bookends of a proposal with the contents to follow, along with a dire warning that time was of the essence. Since then, Congress has been poring over the Bush administration's proposal, making various improvements to it, and trying to find common ground for consensus. On the Budget Committee, we have a limited role in legislating the proposal before us, even though it has major repercussions for the budget. Just 2 weeks ago, the Congressional Budget Office released its updated and economic forecast and warned us of large, unrelenting deficits that lie ahead of us. Economic events since then have only worsened the outlook. The Bush administration has requested an unprecedented sum, $700 billion, to shore up failing firms, to stop panic in the financial markets, and to keep the economy from backsliding into a protracted recession. Our hearing today will examine the impact of the President's request on the budget. The President has called for Congress to act with dispatch, but we must also act with diligence and deliberation as we consider his request, and that's the purpose of today's hearing. To that end, I decided yesterday, and Mr. Ryan graciously agreed, to move this hearing up from its scheduled time on Friday. Although the time for floor consideration has not yet been set, I was concerned that a hearing on Friday would come after the bill was considered on the floor. I want to commend the staff of the Budget Committee on both sides of the aisle, Democrats and Republicans, Tom Kahn, Austin Smythe, who've been working in a collegial, bipartisan way to analyze the proposals that were sent to us. We were concerned that the proposal in its original form did not adequately account for market risk and therefore understated costs. Our staff has been working with the staff at OMB on the proposed scoring of this proposal so that it better reflects the market risk involved. Budget Committee staff have also helped add to the bill periodic requirements for the reporting of funds dispersed, assets acquired, and the estimated recovery or repayment of those assets. Our witness today is Peter Orszag, the Director of the Congressional Budget Office. And I want to thank Dr. Orszag for rearranging his schedule on short notice so that he could testify. I also want to thank his staff for all they've done to help us analyze this proposal. CBO has been working overtime on written testimony, and most of our members probably did not see the testimony of Dr. Orszag until they arrived here this morning. I would encourage everybody to read it because it is an excellent statement of the situation. And I would also encourage Dr. Orszag to take whatever time he needs to give us a thorough, complete analysis of how CBO analyzes a request and how it should be reflected in the budget. Just by way of background, let me lay out the budget question that is mainly before us. There are two conventions for recording the President's $700 billion request, should it be granted. Under traditional scoring, when the federal government purchases an asset, the purchase payment is shown in the budget as an outlay, but there's no corresponding entry for the value of the asset acquired, not at least until the asset is sold. When it is sold, the sale price is booked as an offsetting receipt or a negative outlay. If CBO follows this method, this convention, it needs to know various things. How much of the $700 billion will be drawn down by the Treasury and paid out, and when that withdrawal will occur. And to complete the transaction, CBO needs to know when the asset is sold and when the receipts are derived from, and the receipts that are derived from the sale. Obviously, these things are difficult to know at this point in time. If the government's disbursement takes the form of a loan, the loan amount is not booked as an outlay, and the subsequent repayments are not booked as receipts. Under the Federal Credit Reform Act, if the loan is deemed likely to repay on a present value basis less than the original principal amount because of losses or subsidies, then CBO books the probable shortfall as an outlay in the year the loan is made. OMB believes that the requested $700 billion should be scored in this manner because many of the assets the government acquires will be mortgage loans, so the government will be stepping into the shoes of the mortgagee. As you can see, the customary accounting conventions are not an easy fit for the circumstances we find ourselves in. Yet the convention used can have a major impact on how the requested $700 billion is incorporated into the budget. Our purpose is to explore these and other budget process issues with Dr. Orszag, and in that connection, let me remind all of our members that Dr. Orszag is not here to oppose or support this proposal before us. He and his staff are here as analysts, not advocates. Before turning to Dr. Orszag, I would normally turn to our ranking member, Mr. Ryan. I understand that he will reserve his place to make an opening statement. Is it going to be a closing statement after Dr. Orszag has testified? Shall we proceed with his testimony? Okay. Dr. Orszag, I think the better part of wisdom is that we proceed with your testimony. Thank you for being here, and your testimony is an excellent statement of the situation, the choices before us, and I would encourage you to take all the time you need to thoroughly explain it to the members of this committee. Thank you once again for your excellent contribution to our effort.
Thank you, Mr. Chairman, members of the committee. Since August 2007, financial markets have experienced severe strains, which emanated from the bursting of the housing bubble and then fed into declines in mortgage-related assets, which then fed into significant difficulties in ascertaining the financial condition of the institutions holding such securities. These problems contributed to a broader collapse of confidence, with the result that financial institutions have become increasingly unwilling to lend to one another. Over the past few weeks, the collapse of confidence in financial markets has become particularly severe. I have a chart that I'd like to put up which shows one illustration of that collapse of confidence in financial markets. This shows, in a sense, the higher you go on that curve, the more turmoil there is in short-term financial markets. And that spike that you see occurred over the past couple weeks. So a very dramatic collapse, which is what drove the Treasury Department to propose the act that is under consideration. One thing that is striking is that the turmoil in the financial markets thus far has had less impact on macroeconomic activity than one might have thought. And indeed, the second quarter showed fairly robust economic growth. A modern economy like the United States, however, depends crucially on the effective functioning of its financial markets in order to operate. And there is little doubt that if the kinds of strains that are shown in that graph were perpetuated, the effects on economic growth, on household income, and on other things that we all care about would be quite severe, if not devastating. To mitigate these risks, the Treasury Department and others have put forward a variety of proposals. In analyzing them, it is crucially important to keep distinct two problems. One is that the markets for some types of assets have effectively stopped functioning, that there's illiquidity in particular financial markets. For that kind of issue, the federal government could intervene as a market maker to reestablish liquidity, and that need not, and I'm going to return to this later, that need not involve any significant subsidy from the federal government to private market institutions. The second problem, though, involves the potential insolvency of specific financial institutions. By some estimates, global commercial banks and investment banks may need to raise hundreds of billions of dollars more to cover their losses. Restoring solvency to insolvent institutions requires additional capital investments, and one possible source of such capital injections is the federal government. These two problems are related in the sense that it's difficult to know which institutions are insolvent if you can't price their assets because of illiquidity in the markets. And conversely, injecting more equity into insolvent or barely solvent financial institutions could help to restore liquidity to some financial markets because each counterparty may be more willing to lend to another financial institution with more confidence that there's a greater capital cushion at that other financial institution to which it would be lending. Nonetheless, the problems are, even though they are related, conceptually distinct, and much of the policy discussion about the Treasury proposal and other recent proposals have muddled or confused the two issues. Indeed, some proposals appear to be aimed primarily at the illiquidity of particular asset markets. Others seem to be aimed primarily at insolvency, and some may do a little bit of both depending on how they're implemented. Given that, let me turn in particular to the Troubled Asset Relief Act of 2008 as proposed by the administration. As you know, the Act would authorize the Secretary of the Treasury to purchase, hold, and sell a wide variety of financial instruments, particularly those that are based on or related to mortgages issued prior to September 2008. The legislation would appropriate such sums as are necessary to enable the Secretary to purchase up to $700 billion of such assets at any point during the 2-year window of opportunity specified under the legislation and to cover relevant administrative expenses. At this time, given the lack of specificity regarding how the program would be implemented and even what classes would be purchased by the Secretary, CBO cannot provide a meaningful estimate of the ultimate net cost of the administration's proposal. The Secretary would have the authority to purchase virtually any asset at any price and sell it at any future date. The lack of specificity regarding how that authority would be implemented makes it impossible at this point to provide a quantitative analysis of the net costs to the federal government. Nonetheless, some observations are possible with regard to what would influence the net costs to the federal government, and I would identify 2 key forces. The first is whether the federal government seeks and is able to succeed in obtaining a fair price for the assets it purchases, and in particular whether it can avoid being saddled with the worst credit risks without the purchase price reflecting those risks. I'm going to return to that in a moment. The second force is whether, because of severe market turmoil, market prices are currently lower than the underlying value of the assets. If current prices reflect so-called fire sale pricing that can result from severe liquidity constraints and the impairment of credit flows, taxpayers could possibly benefit by buying now, holding the securities, and selling them as prices return to those underlying values. But let me return to that first force and whether the federal government will obtain a fair price for the assets that it's purchasing. The Treasury, that will depend not only on the types of assets that are purchased, but how the transactions are conducted. The Treasury has indicated that it would conduct reverse auctions for at least some of the purchases. And I would note a reverse auction can work well in some cases, but it's not magic. It only works well under certain conditions. In particular, under a reverse auction, the sellers offer to sell you something, and someone will offer, I'll sell it to you for $100, someone else will say $90, someone else will say $80, and instead of a regular auction where the price goes up, the price goes down so that you get the lowest bidder winning the contract, thereby getting the best price possible as a buyer, thus a reverse auction. In the context of financial assets, a reverse auction works best when different sellers are offering to sell their shares in the same asset rather than offering to sell different assets, and also when many sellers participate. When sellers are offering different assets, the lowest bidder may win by offering an asset with particularly risky or poor future prospects, and the price may not reflect the degree to which the specific asset is impaired or risky. Consequently, the federal government could purchase too many risky or impaired assets without enjoying sufficient price discounts. Similarly, if the number of bidders or participants is unduly limited, the government could overpay relative to a fair price. One focus that Treasury has identified for the program is mortgage-backed securities, and they have indicated that they may conduct reverse auctions on a tranche-by-tranche basis, that is, on a CUSIP by CUSIP for each individual cash flow associated with a mortgage-backed security, reverse auctions on that basis. That would work relatively well, and to the extent that the program was limited to that kind of auction for that kind of security done in that kind of way, you are likely to get a price that reflects the underlying characteristics of the cash flows that the federal government would be purchasing. Reverse auctions may not obtain a fair price for the government for many other types of assets that may be covered under the program though. In particular, for example, if the federal government went out and bought loans themselves from banks, you are very likely to wind up with the worst quality within any given risk classification and to wind up overpaying for those individual assets. Basically, the problem there is that the seller has more information than you do about the characteristics of the asset, and there is no way that a reverse auction can ensure that you're obtaining a sufficiently low price for the risk characteristics of what you are purchasing. Substantial purchases of those types of assets would make it unlikely that the Treasury could operate the proposed new program at little or no net cost to the taxpayer. In other words, the more that the Treasury program concentrates on assets that are difficult for a buyer to value, the more likely that the government will overpay. And the more that that occurs, the more the program moves beyond simply reestablishing trading in illiquid financial markets, and the more it instead subsidizes particular financial institutions selling those assets to the government in a manner that seems unlikely to be an efficient approach to addressing concerns about insolvency. The written statement includes some discussion of alternative proposals, including direct equity injections. I would be happy to answer questions about that, but especially since I see that Mr. Ryan is now here, I will end my oral statement with that. Thank you very much, Mr. Chairman.
Thank you, Chairman. Apologize for being late. As you know, there are a lot of meetings going on in this building right now, to which many of us are attending, and this is a real serious situation. By nearly all accounts, the turmoil in our financial markets last week was unprecedented in recent history. Clearly, and I think rightly, Americans are genuinely worried, and all of us here, Republicans and Democrats, are very concerned about this situation we find ourselves in. We know that our markets are in serious trouble. And we also need to understand that this just isn't a problem for Wall Street. It's also a problem with potential harm to our entire economy. And everyone and everything from small businesses to workers to senior retirement accounts are at risk here. I think there will be an endless debate over the next few months, maybe years, as to how we got to this point. And there were certainly many contributing factors. But clearly, two of the biggest were, number one, a monetary policy that kept interest rates artificially low and encourage imprudent and often outright reckless borrowing and lending. Number two, Fannie and Freddie's buildup of investment portfolios to boost profits, all at the risk and now likely expense of the taxpayers. For the past few months, Congress and the administration has scrambled to address each of these episodes, dealing with whichever crisis had come to head at the moment, but not really doing anything to address the underlying problem and thus prevent the next crisis from popping up. This week, of course, we are all working with the administration, with Treasury, to deal with this crisis. The administration has proposed an ambitious, unprecedented plan to address this problem and to stem some of the fallout to the larger economy. The plan would provide Treasury the authority to purchase up to $700 billion in private mortgage-backed securities. And yes, I have genuine concerns about giving Treasury or anyone that kind of authority. Finally, and a primary concern to this committee, what is all of this going to mean to the federal budget? Dr. Orszag, I know that at this point, the most accurate answer to this question is probably we just don't know. But that said, this is the business of this committee. We're going to have to figure this out. And I very much appreciate, Dr. Orszag, you doing your best today under the circumstances to give this committee your best assessment of the potential impact of the bailout legislation working its way through Congress this week. And, Mr. Chairman, I thank you for indulging me with the opening statement. Appreciate it.
Turning to questions for our witness, I would ask unanimous consent that all members be allowed to submit an opening statement for the record at this point if they so choose. Without objection, so ordered. Dr. Orszag, I noted in my opening statement that, broadly speaking, there are two conventions for booking assets like this. One is to treat it as the purchase of an asset, but oddly enough, when you do that, the asset acquisition price or payment is booked as an outlay, but the value of the asset itself, the corresponding value of the asset, is not entered anywhere on the federal books until the asset is sold. At that time, the proceeds of the sale are treated as offsetting receipts or as a negative outlay. The other is the Credit Reform Act, in which case you try to calculate the likely losses and subsidies downstream, discount them back to present value. To the extent the present value is less than the original amount of the loan, you've got a loss that is booked in the year of the loan. Which does CBO prefer to undertake in this case?
The latter, and in particular, it's CBO's view that the budgetary treatment, if we went out and we bought in a liquid financial market where you would imagine that the federal government would be obtaining a fair price for an asset, we go out and we buy an asset for $1 in a liquid market. The best budgetary treatment of that is basically that there's zero net gain or net loss at that point because you've purchased something for $1 that's worth $1, and that what has happened is that the government has rearranged its portfolio rather than caused a deterioration in its fiscal condition. That's much different than going out and buying a tank for $1, if you could buy a tank for $1. So what we think is the best way of measuring these kinds of financial transactions is the degree to which what you're purchasing doesn't reflect liquid markets or doesn't reflect a competitive bidding process, and it's the net subsidy that you're providing. So if you go out and you buy something from a financial institution for $1 that by some fair value accounting basis is only worth 50 cents, the government should show a 50-cent subsidy.
And that would be the amount.
And the reason is that is what causes the deterioration in the government's fiscal condition. It's the subsidization that causes the deterioration, not just swapping assets on a fair market basis.
And that would be the amount that would be added to the deficit in that year.
That's under the proposed accounting treatment and under what we think is the best way to account for these transactions. Yes.
So, in all likelihood, it will be substantially less than the requested amount, $700 billion.
One would imagine that it should be substantially less than $700 billion, the net cost, yes.
Now, on page 3 of your testimony, you say, at this time, given the lack of specificity regarding how the program would be implemented and even what asset classes would be purchased, CBO cannot provide a meaningful estimate of the ultimate net cost of the administration's proposal. The Secretary would have the authority to purchase virtually any asset at any price and sell at any future date. The lack of specificity, of course, makes it difficult for you to do anything. However, on the next page, you say, CBO expects the Treasury would probably fully use its $700 billion authority, but the net cash disbursements under the program will be substantially less than $700 billion. Would you explain that?
Sure. It just returns to the discussion we were just having, that the net impact on the federal government presumably will be significantly less than $700 billion unless you lose 100% of the value of whatever you're purchasing. So I can't quantify what the net gain or loss would be without knowing whether the federal government's purchasing whole loans or tranche by tranche reverse auctions on mortgage-backed securities or more esoteric products. But it would seem implausible that the federal government would lose 100 cents on the dollar for every purchase that it made, which is what justified the statement on page 4.
Do you know, and can you explain to us what scoring approach OMB intends to take?
My understanding is that OMB intends to undertake, and the legislation reflects, a similar scoring process in which, while the methodology may differ slightly, the result is the same, which is to say the cost that is shown on the federal budget will be the degree to which the federal government subsidizes the purchase of particular assets.
Would the estimate of credit cost vary from transaction to transaction, depending on the terms of the transaction?
I would think so, yes. So again, returning to the basic point, if the federal government said, even through an auction process, we're going to go out and buy specific loans from different banks, it is much more likely the federal government will suffer some losses on those transactions, not only because you're likely to wind up with, even with any given FICO score or any given risk classification, the sort of worst part of the distribution of the asset classes as financial institutions are selling you the stuff that they most want to unload, but also because as various parts of the legislation now reflect, the federal government may well be a more lenient owner of that mortgage than the bank itself was in terms of foreclosing and other measures.
You give us a graphic description and a good description of what's happened in the illiquid credit markets. Can you give us your analytical view of what could happen if we don't provide some substantial and extraordinary assistance?
Let me back up. Being able to obtain credit is crucial for households, and it's crucial for firms. Our entire economy functions because people are able to obtain financing for what they want to purchase, and for firms, what they, new plant and equipment and investments that they want to make. And if that system collapses, we will have severe turmoil in the real economy, which is to say in our real lives in terms of our jobs, our output, and what have you. So that's the fundamental problem. We've already seen some ominous signs emanating from capital markets. Corporate debt issuance plummeted in the third quarter. The short-term asset-backed commercial paper markets are under severe stress. Bank lending, it is implausible to me, given the tensions in the banking sector, that even though bank lending so far has held up fairly well, that it will not also come under severe stress. So the various places where you can go for liquidity are drying up, and that is a huge problem to the economy.
Dr. Orszag, thank you very much. We'll turn now to Mr. Ryan.
Let me just pick up where the chairman left off, because that's kind of the line of questioning I wanted to go to as well. Using the Credit Reform Act scoring methodology, but looking at this bill, Treasury is going to basically determine how to set up these auctions. And since we don't really have a price discovery mechanism right now, because we don't have a market for these securities, given that these mortgage-backed securities aren't, no one mortgage-backed security is like the other, you're going to have to give us a rear-view mirror score on this, correct? I mean, typically when we pass bills here, you give us an estimate on what it's going to cost, and that factors into our budget, and therefore we make decisions based on these cost estimates. Is it basically not the case here that if this passes and we give the Treasury the authority, then they go forward, set up these auctions, a price discovery mechanism, and based on the price they pay for these securities, then the subsidy is determined? You're not going to be able to give us a true cost of this until after these trades occur. Is that not correct?
Well, yes and no. I think we could provide more information to you and at least an estimate of what the subsidies are likely to be if we knew, even before the trades occurred, what the structure of the mechanism was and what the asset classes are. So in particular, if the Treasury said we're going to only do, again, tranche by tranche.
AAA versus mezzanine versus all this other stuff.
Well, and it's more important, even beyond that. It's they're talking about hundreds of thousands, if not millions, of mini auctions. So it's not, we're going to go out and buy AAA rated paper, sell us what you want, and we'll determine a price. It's on mortgage-backed security number blah blah, 123753, which is then a tranche of that is then owned by 50 or 100 different institutions. We're going to go out and bid just on that tranche.
Okay.
And you 50 or 100 institutions, you bid for us, we're going to buy 20% of the total. That is likely to obtain a fair price. So if that's all that we were doing, I would say a fair guess is zero. If we're going out and we're buying, again, just to return to the example of individual loans from banks, what we would provide to you then is some analysis up front before we knew what the individual transactions are of if they say we're going to conduct auctions for FICO scores between, with the following ranges, we would look at what the distribution of performance of loans for those given FICO ranges are, assume the federal government's going to wind up with tilting towards the bad end of that distribution given the incentives for financial institutions, and give you some estimate based on that. So in other words, if they went out and they said, we're going to put $200 billion into reverse auctions on a QSIP by QSIP basis on mortgage-backed securities, $150 billion into purchasing individual loans in the following way, and what have you, we could at least give you some estimate of what the net subsidy would be across those different asset classes, but we don't even know that.
Right, so once the methodology is determined by Treasury, then you can start giving us estimates.
Yes.
Treasury, they have a couple of concerns, meaning they want to pump liquidity into these firms, into these banks, and they want to get these bad assets off the books, and we don't want the taxpayer to have to pay for it. We want this to be a net, zero coster. We're kind of at odds here, aren't we not?
Yeah.
I mean, if the goal here is to pump liquidity into these institutions, that means they're not intending to pay fire sale prices for these securities. They're going to pay above fire sale prices. If the goal is liquidity, that means the taxpayer is going to pay for some of this. Is that not correct?
I think we need to be very clear about what we're trying to accomplish here, because the descriptions about what the programs are trying to accomplish often do get muddled. And as I mentioned before, there are two problems. One is many financial institutions may be insolvent, and are we concerned about that? The second problem is various financial markets, like I showed on my graph, are not functioning effectively. Solving that second problem need not involve any significant subsidy from the federal government. Solving the first problem does.
Right.
To the extent that we implement these programs in a way where we overpay for assets, we are sort of in a backhand way addressing the insolvency issue, even though the program is framed as addressing illiquidity. And I would go beyond that and say we're likely to be addressing the insolvency issue in a kind of haphazard way, where we're providing support to particular financial institutions that may not be under stress, not providing support to others that may be under stress. And if we're going to address the insolvency issue, it may be better to do it directly. I'd also note, by the way, one other thing, that restoring liquidity to particular financial markets may actually exacerbate insolvency concerns, because there's lack of clarity right now about which institutions are or are not insolvent, in part because many financial institutions are not fully marking to market. They're using flexibility not to fully mark their assets to market.
Play it out longer.
To play it out longer. And that's also creating some illiquidity because they don't want to sell at current market prices, given that that would then require them to book the losses and perhaps trigger problems. If we establish pricing for these assets, many institutions may be revealed to be insolvent because they would then have to mark to market, given the rules, which may look like a bad thing because the number of insolvencies would go up. But then again, I would say, to the extent that you have these sort of hidden insolvencies throughout the financial system, one of the reasons that trust in the financial markets is now undermined is precisely that concern. So if we revealed which institutions did and didn't have problems, even if that caused some insolvencies to be revealed, the net result may be positive in terms of restoring confidence that the people you're dealing with actually are solvent.
So when we establish price discovery, that's going to occur. If we subsidize the price discovery, we're going to delay the inevitable insolvencies that just have to get flushed through our system.
Well, if you subsidize the asset purchases, you're doing two things. You're sort of establishing some more price transparency, but you're also then transferring resources from taxpayers to particular financial institutions in a way that may be haphazard.
So if the goal here is solvency, is capital injections, it's a pretty crude tool we're using here, and we may not be giving them to the healthiest organizations or institutions that ought to get the capital injections, and that's basically what you're saying. If the goal here is a liquidity issue, that's one thing. If it's a solvency issue, this is not the way to go about doing it, correct?
Well, just to return it, I would say if it's a liquidity issue, then one should focus on trying to get the best price possible for the federal government and avoid overpaying.
Right.
And to the extent it's a solvency issue and you're addressing that by overpaying for particular assets, you're kind of scattering money across lots of financial institutions, some of which may be perfectly healthy and not need help from a solvency perspective, and you're overpaying them too.
Yeah, and we will simply delay inevitable bankruptcies. I'll just finish with this. Let me ask you your professional judgment. I mean, you're a trained economist. Do you see our problem primarily as a liquidity problem or as a solvency problem? Meaning, and I think we just went through this a bit, do financial institutions suffer from a lack of short-term funding, or have their assets declined to such an extent that they need to be recapitalized? What do you think is, in essence, the primary problem here?
I think both problems exist.
So you think they're twin?
I think both problems are affecting financial markets, yeah.
All right. Thank you.
Oh.
Thank you, Mr. Chairman. Dr. Orszag, thank you. I know that this is the Budget Committee, and the questions are technical with regard to the budget. I am trying to put myself in the shoes of middle-class Americans who are trying to understand, in essence, what is happening. And quite frankly, there hasn't been any real explanation to middle-class Americans about what is happening to this nation. And reverse auctions and liquidity and insolvency and short selling and naked shorts and all that they have no understanding. They just know that they're already in a very severe economic crisis and real economic insecurity in their families. And what is all of this going to mean to them? You started to say, and I would like you to address this, because you said something in your commentary that said that credit is stability, in essence, what you said. if you can describe what this financial situation at this moment, in the absence of whatever program we may potentially be looking at in terms of trying to bring some sense out of insanity here, how would you describe this to middle-class America and saying, this is where we are, this is what this means to you, this is what happens if we do not act, and what are the kinds of pieces that need to be put into place in order to safeguard your economic security in this morass?
And I'm going to try to avoid using any big words in doing this.
Thank you.
Financial markets, so I will speak slowly and not use big words. Financial markets, that is banks and the people that, the institutions that lend to, let's just take a hypothetical household. They work for a company XYZ, they own a house, they own some cars, okay? The company that they work for finances its operations, so you know, what it makes whatever, widgets or whatever you want it to make. And it relies on borrowing from lots of financial markets and from banks in order to do what it does. Right now, financial markets are suffering a collapse of confidence. The institutions that would normally lend to your employer are reluctant to do so, in part because of this turmoil surrounding, again, lack of confidence. And the company itself would often sometimes issue debt to finance its operations. It would issue a bond or something like that so that it could have cash to pay your salary. That's also under stress. It would borrow for short periods of time and then pay the money back when so let's say it had a new set of inventory coming in. It would borrow a little bit of money to buy the inventory, and then as it sold this stuff at stores, it would pay off that short-term loan. It's having trouble getting that too because of this collapse of confidence. Similarly, ultimately, the bank from which you got your mortgage and the bank that financed your auto purchase, they're under stress too. They don't have enough capital to lend you that money. So, and that's in part because they're having trouble borrowing from other banks and other financial institutions. So this implosion of confidence among financial market participants ultimately will affect you, even though right now it may seem really esoteric and kind of just out there in some other world. It will come home in the form of your company having trouble financing its operations, and it will come home in the interest rates that you have to pay on mortgages and auto loans and what have you. And those effects may be somewhat delayed. The history does suggest that those kinds of effects occur some period after the financial market turmoil itself begins. But they do happen.
Quickly, let me ask you this. One of the main causes of this was the subprime mortgage, a crisis, if you will, that the whole issue of how mortgages were issued, et cetera. If that being the case, with all of the potential relief that we're trying to bring to the markets here, in anything that you see with any of the current plans that are on the table, the conditionalities, et cetera, is there anything that is essentially looking at restructuring, if you will, our mortgage institutions fundamentally and in the way they do business and the mortgage contract? Is there, do you see any of that in anything that we are looking at, if that was the root cause of this problem?
I would go broader and say we're in the middle of a potential crisis, and there are a variety of things that seem targeted at that, although with some ambiguity about exactly what they're targeting, as we were just discussing. And then secondly, there are a whole series of structural and regulatory reforms, not only on home mortgages and commercial mortgages, but in terms of the overall regulation of the financial sector that are under discussion and that are worthy of serious consideration. I don't see them moving at the same speed as this proposal appears to be.
On what side? Where's the speed? On the financial institutions versus the mortgage side? What?
No, I just meant
or
that
the regulatory process.
The whole question of how to
Regulate.
restructure the regulatory
Sorry,
apparatus, which I want to say is in need of restructuring, but one also needs to be very careful. We often fight the last war and create the seeds of the next problem by making changes that seem attractive at the time, but then create problematic incentives later on. So as we move forward in restructuring financial regulation, including for mortgage originators and the whole mortgage process, one needs to be very careful to make sure we're not just fighting the last war, but also looking forward to preventing the next one.
I just will get to you a copy of an article in the New York Times, September 21st, by Robert Schiller at Yale, the Arthur Ocon professor of economics at Yale, talking about the mortgage of the future and some ideas about
Yes.
how to restructure, and I'd love to get your views on that.
Let me
Thank you
just
very
very
much.
briefly pause. This is a little bit outside of the immediate hearing, but
Right.
Bob Schiller and others are emphasizing something that I think is crucially important, that in financial markets and in the rest of public policy, we need to be paying more attention to psychology and a little less attention to the purely rational Econ 101 version of the world where everything's frictionless and things work perfectly. Because in the real world, that often tends to be particularly important, and Bob Schiller is among the leaders in advancing that field of thought.
It talks about continuous workout mortgages and us investing in that. Thank you very much, Mr. Chairman. I appreciate your
Mr.
sharing
Henson.
with me.
Thank you, Mr. Chairman, and thank you for calling this hearing. Clearly one of the most important hearings I've attended in my congressional career. For many of us, I think we feel like are being faced with a financial panic and crisis on the one hand, and potential taxpayer bankruptcy and a fundamental change of the role of government in a free enterprise economy on the other. For those who may think that Congress will choose between those two options in 72 hours, that is a rather naive thought. So I appreciate, Mr. Chairman, you holding this hearing. I think I understand the short-term gain to be had by the Paulson plan or some permutation thereof, but clearly this committee also needs to focus on potential long-term pain to the taxpayer. Although we reviewed it before, Dr. Orszag, simply the federal government that we have today left on automatic pilot, isn't it more or less the consensus of CBO, OMB, GAO, that without any fundamental changes in the programs we have today, that if we wanted to balance the budget through tax increases only, that we would essentially have to double taxes on the next generation? Is that not the glide path that we're essentially on?
Very substantial increases in revenue would be required. We have substantial increases in spending driven, as you know, mostly by our health programs under current policy.
So we're coming off, I believe, the single largest one-year increase in the federal debt, the single largest unfunded obligations we've ever had at roughly $57 trillion, and the long-term prospect is not good today. So on top of that, we are looking at perhaps a $700 billion program. Some say, and I believe you've opined, that maybe there's a possibility the taxpayer actually made money out of this. But first, let's look at history as our guide. And you have greater expertise on this than I do, but the closest incident I can find is the S&L bailout of the early 80s. My reading in real dollars is that cost the taxpayer roughly $150 to $200 billion. Do you have a different reading?
That's
of that?
roughly the same range that I agree with that range.
So it is certainly not axiomatic that somehow the taxpayer is going to make money if they buy a bunch of troubled assets. There is certainly the potential for great loss.
But let me just clarify that, and there have been parallels drawn to the Resolution Trust Corporation, what have you. It's a much different situation. That loss occurred mostly because the federal government had insured deposits at institutions that then failed. And the assets, the Resolution Trust Corporation, the asset part of that was when the institution failed, we took over the asset side of their balance sheet in addition to the liabilities, and then we sold off the assets. That's a much different thing than going out and buying assets, seeing what price you can get for them, and then later selling them.
But they're still illiquid assets in many places without a functioning market. Let me also ask you this question. There's certainly a cost in allowing financial institutions to fail, and as you well point out, there is a huge psychological component to the capital markets. But isn't there also a cost to keeping some institutions open that perhaps should be forced to realize their losses? Is there a parallel to the lost decade in Japan where essentially by trying to keep failed financial institutions open, they enjoyed a decade of stagflation and negative economic growth? Might that be a potential cost to this plan?
Yes.
That's an easy one-word answer.
In particular, perpetuating, so I think the lesson of history suggests that especially in banking crises, that perpetuating insolvent institutions just raises costs. And it's better to address the problem up front, take the problem assets off the books somehow, or address the problem directly. And I think the Treasury folks would say they are trying to do that.
And looking, a number of members of Congress, Dr. Orszag, as you probably know, are looking at a lot of options. And clearly there are many lousy options on the table, and to some extent it's a choice. It's having to choose among lousy options. Some wish to explore a secured loan program versus Uncle Sam walking in to try to buy up troubled assets from institutions that may not deserve it and may not deserve, and may pose longer-term systemic risk to the economy by staying open. How would, under CBO scoring, maybe the answer is the same, are we essentially trading asset for asset if conceptually the program was structured as a secured loan program as opposed to an asset purchase program?
Yeah, again, I've heard some discussion of similar proposals, and the scoring would be the same. The question is, so you're extending a loan secured by some underlying asset to a financial institution or someone else. And the question is, what are the loan terms, and are you subsidizing that facility or not? And if you're not, the net cost is in expected value is zero.
Thank you, Mr. Chairman.
Dr. Orszag, I'll leave the debate for another day on how we got into this mess, and to what extent unpaid for tax cuts and the deregulatory philosophy were major contributors to all of this. I think we all recognize we're facing a serious crisis. My first question to you is this potential crisis so severe and so imminent that the difference between Congress acting by Friday of this week or Friday a week later could make a difference in the economy?
I can't answer that. What I can say is that if there's no action taken and Congress departs and there's just nothing, that you are running a very substantial risk of utter financial crisis. Whether it has to happen over the next 72 hours or the next week or 10 days is impossible for me to say, and I don't think anyone can say. It comes back to the role of confidence in psychology. That is at heart what we're dealing with here, is the confidence of financial markets.
Would it be your best judgment, and I realize it's subjective judgment, but would it be your best judgment if the congressional leaders, Republicans and Democrats alike, said, we are going to have a rescue plan, it will be significant, but we're going to take an extra week to get it right rather than to push it to the president's desk under a gun?
Again, I think my perception is the key thing that financial markets are looking for now is the existence of a significant package. And I suppose that coming out with a statement of principles or agreement that there will be a package and then we're going to make sure that we reach agreement on that within some period of time would fulfill that purpose.
Okay. My next question is, what would be your expected projection on the impact on short-term or long-term interest rates when the United States government goes out in the markets and borrows $700 billion?
It's a great question. It depends on the degree to which, two things, the degree to which we actually wind up subsidizing things, and secondly, the degree to which financial markets perceptions and psychology matter. So let me just, in a purely rational, everything works like a textbook suggests, any effect on interest rates and the exchange rate should only reflect the degree to which the nation's underlying fiscal condition is deteriorated as a result of these interventions. And again, if we're getting a fair price and there's no net subsidy, that's just a wash. That should be You're just trading one asset for another. It shouldn't cause any, at least in a purely textbook kind of rational way, shouldn't cause any financial market effects, including on interest rates.
Okay.
But to the extent we do subsidize the purchases, that should show up in interest rates and the exchange rate. And secondly, to the extent that financial markets don't have clarity about whether we're providing a subsidy or not and are guessing about that, there can also be effects on interest rates and exchange rates from that.
Okay. My final question is this. Give me the best case scenario, the worst case scenario, and what you think is the most likely scenario of Congress taking no action. And when I say best case and worst case, I mean in terms of impact on GDP, I mean in terms of unemployment rates, I mean in length of a recession or potential depression if you're talking about the worst case scenario.
You're asking me if Congress does not act, what the effects would be?
I'm asking you, Congress takes no action.
Yep.
Make that assumption. What is the worst case scenario? What will happen to our economy in terms of GDP growth, in terms of unemployment rates, length of a recession or potential depression? And what would be the best case scenario if Congress takes no action? And then if you still have time, what you think the most likely scenario would be?
I will just come back to saying that if having created the expectation in financial markets that there will be a package, and given the stresses that we saw last week in financial markets, if there's no package whatsoever, there is a very significant risk of utter financial market chaos, which will then have significant effects on the real economy in a way that I think isn't particularly helpful for me to lay out in its full gory details, but it would be a very bad situation.
Well, let me focus on that because I want to make it clear. I'm talking about the worst case scenario, not your most likely projection. But we need to understand, and looking at the costs and benefits of taking action or no action, and one of the costs of taking no action is the worst case scenario. Is it possible that the worst case scenario if Congress takes no action is something similar to the market crash of 1929?
Again, I don't want to start speculating on the precise quantitative magnitudes other than to say you would, in that case, I think, have a financial market meltdown, which would cause very severe economic dislocations, which may be on the order of magnitude of Great Depression type effects, but exactly how it plays out. One of the things about crises is they can play out in such a terribly diverse array of ways that speculating on exactly the specific way that a crisis plays out doesn't seem productive to me, other than to say it would be very serious.
Okay. Thank you.
Thank you, Mr. Chairman. And I appreciate my good colleague from Texas not wanting to debate how we got here, because I too would like to defer that, and whether it goes back as far as the Community Reinvestment Act and the seeds of that causing it to, we can have that debate at a different day. Peter, would you cut off your analysis of the family impacts? Talk to us a little bit about the impact that reduction in business and slowdown for that particular business would have on the family's 401k, to the extent that it might be invested in company stock, and the impact that have. And then also visit with us about the risks that this could severely damage the overall U.S. economy, and kind of give us a magnitude. We had a guy yesterday give us a kind of a back-of-the-envelope guess as to what federal revenues might be impacted if we had a 1% increase in the economy or a 1% decrease in the economy. So flush out the impact on the family in addition to the jobs and those kind of things. What happens to their 401k and the retirement planning?
Well, again, to the extent that asset prices decline, their 401ks and IRAs and any other assets that they have would decline also. To the extent that you're causing further disruption to the housing market and shutting down any additional mortgage lending or making that much more expensive, you're also curtailing or reducing their house price, perhaps even further, raising difficulties for them to finance any new purchases, even if they would want to, given the threat to their employment and income because their employer is having difficulty. So all of these things become a self-reinforcing negative spiral, and the fact that they're then less confident about their future and not going out and buying the new refrigerator means that the seller of the refrigerators has lower sales, and that is the kind of scenario in which you can have a very substantial downward spiral that affects the macroeconomy. You're then also right. If we were to enter a severe recession, federal revenue would be significantly adversely affected. And in addition to that, various kinds of spending would go up, including things on food stamps and unemployment insurance and what have you. The net result of which would be to take the deficit figures that have already been spoken about and raise them significantly.
I give you your thoughts on, as I look at the circumstances, the most immediate issue to me is a seizing up or a freezing of this overnight credit market that's really below most people's radar screens. I was in a bank and used to run the bank's long and short-term portfolio, and all extra cash every night was invested. And you just assumed it was coming back the next day. That's, to me, that's the crisis of confidence and the
Yes.
risk to the system. How does dealing with the housing, the subprime mortgages, and all these other kinds of things, fixing that, do you see that instilling the confidence or restoring the confidence that these individuals across the United States who are making those overnight decisions will have that the money's going to come back the next day? Is there...
They're related, and let me pause on this for a second with the chairman's indulgence, because I think this is crucial. This is what one of the most salient aspects of the crisis has been, which is, to a first approximation, financial institutions are no longer lending to each other on an overnight or short-term basis. Instead, it's being intermediated through the Treasury and the Fed. So instead of financial institution A that has extra money lending directly to financial institution B that needs the money for the day or for the night, the financial institution that has extra money is lending money to the Treasury, which is selling additional debt. The Treasury is taking the cash and putting it in the Federal Reserve. The Federal Reserve is taking that money and lending it out to financial institution B, because financial institution A is unwilling to extend the credit to the other financial institution given the risk of not being repaid, whereas they're confident that the Treasury Department will repay, is good for the money, or that will all work out well, and the Federal Reserve is willing to lend to financial institution B. It is not a healthy development for the federal government to be intermediating overnight and short-term transactions in that way and to that degree, and that reflects the collapse of confidence. So then the question becomes, what jumpstarts that confidence again? And the two approaches, broadly speaking, are to restore liquidity to various asset classes that are currently illiquid. I'm not lending to you because you've got $200 billion of mortgage-backed security stuff on your books, and I'm not really sure
what they're worth.
What it's worth. So that's one way of approaching it. The other is, I'm not worried you have enough capital, even if I knew that what the $200 billion was worth, that you have enough capital cushion if housing prices and mortgage-backed security prices decline, that you'd be able to repay me, given the difficulty you may have in raising capital yourself. So I want you to have a bigger capital cushion. And that leads to the equity injection or more solvency prism or perspective on the problem. Either approach could help significantly, and in fact, in some sense, that is the driver of the crisis. That having that overnight lending collapse, as that chart showed you, is a very unhealthy development, and putting the federal government in the middle of all those transactions is not a salubrious way of running a financial system.
Well, in spite of your telling us you were going to use long, big words, salubrious is...
Yeah,
anyway, thank you, Mr. Chairman. I yield back.
Thank you, Mr. Chairman. Thank you, Dr. Orszag, for your very helpful testimony. I'd like to divide the problem into three levels. Number one is fighting individual fires.
Yep.
Number two, fire control policy, a systemic solution. And number three, talking about the fire department. First, talking about fighting individual fires, financial fires. How much capacity does the Treasury Department or the Fed have to take on an individual case today, like an AIG or a Lehman Brothers or a Bear Stearns?
Federal government has substantial capacity to take those on. The question is whether that's the most efficient way of doing it. And the concern is that financial markets, without a more systematic approach, get concerned about a particular institution, AIG, and then we step in on that, and then they become concerned about some other institution, we have to step in there, and that it's like the whack-a-mole game where something keeps popping up and it's very difficult to keep up.
I share those concerns, and I want an efficient solution. we are going to have a substantial debate over the efficient solution of fire control policy, so it's no longer just whack-a-mole. But your answer did seem to indicate the federal government has still substantial capacity to take on the moles as they need to get whacked.
At
Yeah.
some cost to the American taxpayer and at some cost ultimately to our outstanding reputation with regard to our debt and risk characteristics. But yes, we can issue a lot more Treasury debt if we need to.
Okay. Second level, fire control policy. Your distinction between the liquidity problem and the insolvency problem is very helpful, and I wish that more a discussion could take place on that. As I break that down, it seems like if the taxpayer invests in solving the liquidity problem, we have a substantial opportunity by buying assets at fire sale prices to possibly even make money, because some bailouts in the past have in fact produced revenue for the taxpayer. For example, the Chrysler bailout when we got warrants. But to the extent we try to bail out insolvent institutions, on the other hand, we can face a substantial risk of not only losing money, but keeping dead institutions alive artificially that probably should be taken out in the market. So we face two different types of choices here that can conflict. But my main question is on the integrity of the fire department. That's the federal government. If we lose the capacity to fight fires, then we're really in trouble. And that's my ultimate concern, because as was discussed earlier, the fiscal gap, the huge unbudgeted, toll liabilities of this country are at least $57 trillion, and if you throw in Medicaid, it's probably 70 or 80 trillion. And we do know that when this administration went into office, the total national debt accumulated over 230 years was like $5 trillion. But now, with the latest administration request, that will be up to 11.3 trillion, greater than a doubling in just 8 years. To some extent, I'm worried that we could lose our capacity to fight fires. And that's the ultimate concern, and that's why Congressman Frank Wolf and I have proposed an entitlement reform commission, so that this Congress and future Congresses can get advice from experts on how best to tackle these gargantuan problems. Because I love Medicare, I love Medicaid, I love Social Security, I want to keep them alive. But the best way to keep them alive is to prepare for their needs.
And let me say two things about that. One, as this committee has heard over and over again, and I don't want to sound like the boy crying wolf, but it is a fact that given the path that we are on, two things. One is we will ultimately wind up with a financial crisis that is substantially more severe than even what we're facing today if we don't alter the path of federal spending. And secondly, that if we were on that path in the future and something like what we're experiencing today occurred, we'd have much less maneuvering room to fight those fires, because we will have already depleted the fire truck.
Mr. Garrett.
Thank you, Doctor. And let me, too, compliment your presentation. For an economist, you are extremely understandable. So I appreciate that. And just a couple points I'd like to go over with you. When I just walked in, I came in after your presentation, but one of the answers to Paul's question was how you put this on the books. And I thought I heard you say something to the effect of, as far as the dollar-for-dollar example, and I thought you made some sort of comment as far as the element of the fact that the Treasury, you don't know right now, A, you don't know the plan specifics, but B, you don't know right now how long they're going to hold these assets. They may hold for a day, a week, a month, or so on. So your question is, does that element of uncertainty go to the issue? I don't think it does, but does it go to the uncertainty for you being able to come up with a figure as far as this on our balance sheet?
We know basically nothing about how this program is going to be implemented with regard to even what assets will be purchased, how they will be purchased, how the structure of incentives for the asset managers that will be acting on behalf of the federal government will be structured. So in that context, what I said was, at this point, we can't give you a quantitative estimate because there aren't any details on which to base a quantitative estimate.
But just the question though is does if you had most of the information, whether they sell them a day or 6 years later, shouldn't, if I understood you correctly, as the dollar for dollar exchange, because when they whether they sell them the next day or 6 years later.
Yeah, that wouldn't be at the top of the list of characteristics that I'd be looking for to evaluate the net subsidy.
Okay. Thank you. On a broader issue, but on the sale aspect, we've heard various things as to what their plan would be. I thought I heard that Chairman Bernanke say on the Senate committee the other day that he would think probably what they would want to do is to hold these securities for their life, their duration, even though they may be 30-year notes or what have you. In reality, if they're home mortgages, most people move in 7 years, so they're probably going to hold them then for 7 years. Assume that's the case, that they hold them out as opposed to the RTC arrangement, which, as you already discussed, is not as comparable, but in that case, it was more of a fire sale. Let's get rid of these things so we can move on. The fact that you would hold them out for that period of time would, A, I presume, get you potentially a better price for them, but B, does that affect the bottom line impact that it has on the economy overall as potentially dragging out, if you will, the negative downward pressure on the economy over time as there's uncertainty of anybody else getting into that market?
You know, I think there's been a lot of confusion about exactly what those remarks meant.
Okay.
And so actually, it's not clear to me that they were intended to mean that the federal government would hold the asset to maturity as opposed to perhaps drive pricing closer to the valuation that would be consistent with holding it to maturity. But again, I think there's been a lot of ambiguity about precisely what those comments did or did not mean.
Could you just give a hypothetical though? What does the impact were the Feds to say this is our policy to hold them out? How's that impact upon the economy recovering during that period of time?
Again, I would go back to it's not actually whether the federal government holds it to maturity, because that comes back to the length of that whether you're selling something tomorrow or the previous day, or next year or 2 years later. Primarily, I think a more important aspect of this is: are you trying to reveal what market pricing is today, or are you trying to come up with some concept of what you think that underlying value on a hold to maturity basis is, which, if you're not doing it through a competitive process, could wind up being very complicated and could wind up having the federal government pay substantially more than current market pricing suggests.
Okay. The proposal that you've been talking about today is the general proposal, the major bailout. And one comment is budgetary treatment of the proposal. But could you go back a little bit to one of the last actions that we did, and we've talked about this, and that's the GSE situation, and just give your comment on not the dollar figure. I'm not trying to put a dollar figure on it, but whether or not and how it should be budgeted.
CBO has suggested that given that these entities are no longer plausibly arm's length from the federal government, in our view, their operations should be combined with the federal government's operations in the budget. And that is the way we are going to be reflecting their activities in our baseline early next year. And by the way, there's a recent development I think underscores the wisdom of that approach, which is, I believe it was last week, the Secretary of the Treasury said, we, the Treasury, are going to go out and purchase additional mortgage-backed securities, and we're also directing Fannie Mae and Freddie Mac to do the same thing. I don't think that those two things should be reflected differently in the federal budget, given that they're based on the sovereign power of the federal government in terms of ultimate direction. And our approach will reflect those in similar ways.
So is that potentially like a $6 or $7 trillion item that you add to the budget, or is it?
Exactly how it's done is a little bit complicated, and it's unlikely to be anything close to those numbers.
Okay, I'd be curious sometime just to
Sure.
explain that. Thanks.
Mr. Becerra.
Dr. Orszag, thank you very much once again for your testimony. Let me move back for a moment. For many years, we've been concerned about the size of the budget deficits that the Bush administration has been running. Bush administration came in 2001. We were told that there would be budget surpluses totaling something close to $6 trillion, about $5.6 trillion over the next 10 years. And instead, we've seen nothing but deficits, record deficits over the last several years, to the point where we have seen over about $3.5 trillion in deficit spending under this administration, some $3.5 trillion added to the national debt, if that's about right.
I don't have the number off the top of my head, but
It's something over $3 trillion.
I'll take your word for it.
Okay. If we didn't have a deficit of over $400 billion that we're looking at for this coming fiscal year, and had we not spent hundreds of billions of dollars each year over what we had over the last 7 years of the Bush presidency, would we be in better shape as a nation to try to help address this financial mess that we are confronting today?
I would say that the lower the public debt is relative to the size of the economy, and the smaller the budget deficit is as you go into a crisis, the better off you are in terms of dealing with a crisis.
It sounds like an economist's way of saying yes.
Yes, it is.
Now, part of that massive debt that we've incurred over the last 7 years went to help pay for the president's tax cuts, the Bush tax cuts of 2001 and 2003. We were told that these tax cuts would help provide economic growth and increase prosperity for Americans. And today, what we know is that deficit spending to cover the cost of those tax cuts has left this country in a more difficult predicament, as we just indicated from the previous question about the size of the national debts and how it leaves us now in a more difficult posture to try to deal with this financial crisis. After 7 years of the 10-year Bush tax cuts, do you see any near-term positive outlook for the economy?
Well, CBO, even before this most recent collapse of confidence in the financial markets, issued a economic and budget outlook in which we projected very significant weakness in the economy for the rest of this year and into the early part of next year, and then thereafter some recovery back to normal conditions. If anything, the financial market turmoil should only make that outlook somewhat more dire.
Yeah. So even now, close to the end of the 10-year Bush tax cuts, we still haven't seen that rosy garden that we were supposed to find after devoting trillions of dollars to these Bush tax cuts that went mostly to very wealthy folks, many of the same folks who probably got us into this mess that we're in right now in the financial markets. Middle-class American families are doing today what they did yesterday, what they did 3 years ago, and they're probably going to continue doing the same thing in a year or 2 years or more from now. That is, they get up in the morning, they go to work, they send their kids to school, they try to save a little money. Most working-class Americans, whether they're in the middle class or not, are doing the same thing they did before, they did today, and they'll do tomorrow. Now, lenders in this country aren't doing what they did yesterday, may not be able to do the same thing tomorrow. Many of the traders in Wall Street aren't doing what they did yesterday, are doing things differently today, and may do things differently tomorrow. But it's the guys on Main Street, that middle-class family, that working-class family, is the one that's being asked to do something differently, even though they kept doing the same thing they did year in, year out. Work hard, provide for their family. Is there a quick way that you can explain why that family that didn't do anything that he or she or that family knows about to cause this financial mess should now all of a sudden be asked to give dumb money? In other words, to have no say. You know, they're the Mikeys in this mess. If you can remember the commercial of 20 years ago, that the brothers would always give the littlest brother, Mikey, the cereal, the new cereal to try.
Mikey likes it.
Yeah, Mikey. Yeah. I don't know if Mikey would like this one, but is there any reason why we should treat the American middle class as Mikey without knowing what we're going to get in coming up with any $700 billion bailout?
Well, again, I think those kinds of questions are really for you rather than me, but I would come back to saying that even if it's not any of their doing, that family ultimately, if we perpetuated this kind of financial market turmoil, will be hit in some unfortunate way, even if it's not their fault or has nothing, no direct connection between what they were doing and the current turmoil. It's unfortunately the case.
Well, then, so unlike the Bush tax cuts that went principally to very wealthy folks, not to middle class, unlike the unpaid for expenditures in Iraq, which probably gave America's families, in many cases, a smaller family because of the death of a soldier. Perhaps in this case, we could try to ensure that if the American family is going to be asked to bail out people that they don't deal with on a day-to-day basis, that we make sure it's an investment for the American family. So if we're going to give any amount of taxpayer money, we have to make sure there's a return for the American taxpayer before we move forward. And certainly at this stage, we haven't seen the administration come up with a proposal that does that for the American family. And you don't need a comment. That's more a rhetorical question, but I thank you for your time here. And Mr. Chairman, I yield back the balance of my time.
Mr. Porter.
Thank you, Mr. Chairman. And Doctor, appreciate working with you the last 2 years. We appreciate your professionalism, and it's been truly a pleasure to work with you, so thank you very much. I will probably be less kind to the administration than even some of my colleagues here this morning. But first, this is actually more of a comment than a question. I think you know that in the great state of Nevada, we have one of the highest mortgage foreclosure rates in the country. In my district, about 1 out of 45 homes. It's a tragedy that's happening. Plus, add to that, the lack of a energy policy for our country has caused great economic hardship for our community of Nevada. The resort industry, visitation is down. We are laying off employees. So not only in Nevada is the price at the pump a problem of getting to work, it's also preventing people from coming to visit our community. But I tell you that there are families that are hurting, and what Wall Street has done is morally reprehensible. And it appears to me that in Las Vegas we have more regulations and enforcement than we've had on Wall Street. I am appalled that we have a crisis of this magnitude that has risen to this level without oversight and without the proper enforcement. And again, this is more of a comment, Doctor, because you're here to try to help us find a solution. I'm here to talk about the problem for a moment. I think the administration should have known about it, and I think they should have known sooner. If they didn't know about it, that's even a bigger problem. But I am extremely troubled that Congress now, in the final hours of a session, is finding or having to find solutions to a problem that didn't just happen overnight. I think we're going to see, Mr. Chairman, I think we're going to see a lot of possible solutions that are presented, and I'm convinced that we need to take some pretty decisive action and do it as quickly as possible. But I want to make sure that there aren't individuals somewhere sitting on a yacht eating shrimp and drinking champagne that have taken advantage of the American people. And I know that it's troubling. The overall majority of the calls I receive from my district are opposed to a bailout. But we have to, of course, look at the ramifications as you've presented this morning. So I want to say thank you for your diligence, Doctor. I again share my frustration, anger with what Wall Street has done and what I think the administration should have seen coming. In fact, a year ago, when we were looking at the mortgage crisis as it was escalating, we should have taken a time out and looked at the ramifications. As my friends have mentioned, that the fire department, I think that Wall Street, I think the SEC, I think the administration, and even many members of Congress have not taken the steps that they needed to take to prevent this from happening. So again, that's not a question, Doctor. Again, I appreciate you being here and being part of the solution. Thank you.
Actually, if I could just take this opportunity, since there were compliments about the testimony, to compliment the CBO staff that has been doing a fantastic job under trying conditions.
Thank you very much. Mr. Blumenauer.
Thank you, Mr. Chairman. And it is frustrating because we've had some conversations in this hearing room about this slow motion train wreck that has been occurring for years now, dealing with a subprime mortgage market out of control, failure to exercise oversight and rein things in. There aren't very many people who I suppose are shocked, or should be. There may be some surprise about the rapidity, but the fundamentals, I think, are not much in dispute. I have just two questions, Doctor, that I would offer up. One, in a practical matter, how long would it take for the relief, the stabilization, the practical application of a modified proposal, similar to what you've heard the administration's plan morph into? How long would it take for that to actually make a difference on the ground? Not talking about restoring confidence, but in terms of actual operation. Are we talking about 6 weeks, 6 months? How
You mean make
long
in
would it
effect
take?
operations in financial markets or out to that household we were
In
discussing?
terms of actually administering a program that would take advantage of the authority that we're giving and go in and start the reverse auction, if it could be done in a thoughtful way, if you could put the administration in place, if you'd have the oversight, if you'd have the workout. Are we talking 6 months?
I
6
sure hope
weeks?
not. Again, the more that it's focused on, you use the example of reverse auction for the mortgage-backed securities, the easier it is going to be to design things and get them in place quickly. The more the federal government's going to be purchasing individual loans, and you're going to have a more elaborate process for making
Yes.
sure that you're not overpaying for those loans, the longer it may take. I would say in the best case scenario, you're talking about weeks, not many months. You have to go out and hire the asset managers and then start doing the auctions.
But, yes, but I'm seeking an order of magnitude. Are we talking 6 or 8 weeks under best circumstances? Are we talking about 6, 8, 10, 12 weeks under
That's
best?
going to depend on how stringent the regulations are with regard to, for example, hiring the asset managers. So if given the draft that the Treasury Department submitted, where it's very open-ended, I think they could go out and contract with asset managers very quickly. It would be a low number of weeks. If there are lots of boxes that have to be checked, it may take somewhat longer. So there's a trade-off between getting oversight and protection and timeliness.
I guess, Mr. Chairman, I would request, and again, I don't want, but being able to have some of the certified smart people you work with, just to talk about some of the applications here. You're talking about getting asset managers, qualified, how you
Avoid incentive problems for them. There are all sorts
Yeah,
of things that are
but
their
getting a
compensation.
sense of
Right.
what the timing is for things that haven't been filled in. That would be helpful.
Okay.
And I have a suspicion that something we could get in a day or 2 or 3 would still be relevant.
Okay.
My second question deals with what's potentially next. Not that it will happen, but recall a few months ago, the furor is over the GSEs and Freddie and Fannie. All of a sudden, we're moving in. Then we have AIG exploding and putting hundreds of thousands, millions of annuities at risk. And now, in a matter of hours, we pivot and we have the latest iteration. I would like, not you're saying that it will, but just give us a sense of what are some of the other contingencies that could potentially require a boost in confidence. Hedge fund black holes and instability. We're talking about the auto industry. I mean, what are the other contingencies that you think about?
That is a frightening prospect to consider. We could walk through all of the financial assets, the trillions and trillions of dollars of financial assets that are held by American households and businesses and that trade on financial markets, and potentially raise concerns about the functioning of all those markets. I can't pinpoint it, and I don't think anyone can, with out 2 or 3 weeks or 4 weeks or 5 weeks, where the problems may arise without the kind of detailed knowledge. For example, the Federal Reserve does have more information about banks than we at CBO have, because they can go in and examine the underlying books and the trades that they're conducting. We don't have that information. So as a little bit of an outsider looking in, it is very difficult to predict what could collapse next. And even the people who have that kind of specialized information have a lot of difficulty doing the same thing.
But you don't have, for instance, specialized information about what's in large hedge funds, for
No.
instance, that might be heavily
not.
leveraged.
I do not.
But that could be a potential pivot point, theoretically.
That is a concern that has often been expressed, yes.
Mr. Chairman, I would hope that we, and again, I'm not trying to pin down Dr. Orszag unnecessarily, but it would be helpful to identify the sorts of things that could capture our attention next month or 2 months from now after we navigate this. And I would respectfully request that
We have reporting requirements built into the bill, which this committee staff, bipartisan, was instrumental in securing in the bill, and it gives us a record of the assets being acquired and an estimate, if I'm not mistaken, of the likely recovery of that asset when it's disposed of.
Thank you.
Mr. Tiberi.
Thank you, Mr. Chairman. Sorry I'm late. I had another hearing that I was attending, and I apologize if I ask a question that's already been asked or if you've already addressed this issue. But from your perspective at CBO, from where you sit, how do we know that $700 billion is the right number?
Frankly, we don't. I mean, the bottom line here is that there is a collapse of confidence in financial markets, and the question is, what will restore that? In the judgment of the Secretary of the Treasury and the Federal Reserve Chair, $700 billion was the right number. I don't think there's an analytical basis for saying that's the right number versus $1 trillion or versus $500 billion. The thing about a collapse of confidence is you never exactly know what restores it, and it's not just the number itself, but lots of other things, including how it's communicated and how it's implemented and what have you, that contribute to its success or lack thereof.
What are the risks for this legislative body to miss the target, either giving too much or giving not enough to that confidence?
I would say at this point, given that we don't exactly know what the right level is, and that it is in no small part a confidence game, unless there were some, again, serious justification for altering that number, given that that number is out there, you probably are running a bigger risk by dialing it in either direction than by restructuring the way in which it's implemented.
What's the risk from your perspective of adding to our debt that much more money?
Depends crucially on how much the $700 billion goes to overpaying for assets versus paying for them on a fair value basis. If we simply take the $700 billion and spend it in a way that we're getting roughly $700 billion worth of assets in exchange and on a fair value basis, then I'm much less concerned about the increase in debt Treasury debt that's required to finance those purchases, because it's basically a swap. However, if we go out and we buy $700 billion worth of stuff that's actually worth $200 billion, and there's reason to think ahead of time that we are overpaying for the assets, that's a much different thing, and that component would cause a deterioration in the nation's fiscal condition and is similar to regular deficit spending.
So how do we, if you were the king of the legislature, which obviously you're not, but you're the king at CBO, how do we in the legislative body try to make sure that doesn't happen? How do we protect that from happening from your perspective?
Well, if one wanted to make sure that you were getting fair value for what you were purchasing, there are ways, for example, restricting the program to reverse auctions on a on a tranche-by-tranche basis for mortgage-backed securities, and other things that we could lay out that are more likely to get you fair value. And then there are asset categories and ways of conducting these transactions that are that are more likely to make you overpay. For example, buying individual loans from banks is likely to result in the federal government overpaying for those loans if it's done through a reverse auction, because you're going to likely wind up with the riskiest part of the loan portfolios and not getting sufficiently low prices for bearing those risks.
Particularly if you're just
taking
buying
over those risks, I should say.
Particularly if you're just buying the bad loans and the junk, right?
And not getting a sufficient discount for doing that, yes.
Okay, thank you. I yield back.
Mr. Scott of Virginia.
Thank you, Mr. Chairman, and thank you, Dr. Orszag. You've indicated in your testimony that CBO cannot provide a meaningful estimate of the ultimate net cost of the administration's proposal, and in response to the latest questions, within a couple of $100 billion, one way or the other, it seems. Now, we've been told that the public ought to be scared if we do nothing. It seems to me we ought to ascertain how scared they ought to be if we spend $700 billion without a meaningful estimate of the ultimate net cost. So let me ask you a question. If enough work has been done on a loan portfolio, billions of dollars worth of home mortgages, for example, seems to me we can take a statistically significant sample of that to find out the value of that portfolio by looking first at the face value of the mortgages, the interest rate, the credit worthiness of the borrowers, the real value of the collateral, and you can estimate the payments to maturity even after defaults are considered. You can apply a reasonable discount rate to get a yield to maturity. If you had that information, could you provide a meaningful estimate of the net cost to the administration's proposal?
Well, and yes, although that's what private purchasers of a mortgage-backed security do. They try to project out the cash flow and whether the current pricing is above and below. But here's the key thing. If an asset manager is hired by the federal government to purchase that thing for us and doesn't bear its own risks from making that purchase, I think the question is, do they have the same incentives as if they were purchasing it for their own books, and whether the same standards will be applied? And furthermore, if you do it through a reverse auction, that kind of scrutiny isn't necessarily applied to each mortgage-backed security.
Well, it seems to me if we did some perfunctory due diligence, we could figure out a good idea of what these things are worth. And without the information, because we don't know the collateral behind these things, we do know that the collateral may not be sufficient in a lot of these loans. We do know that the borrower's creditworthiness wasn't checked, and we're trying to figure out what these things are worth without the perfunctory information.
Yeah.
I mean, doesn't it insult your intelligence to be asked to comment on a plan where you don't know what you're getting or how much you're going to pay for it?
I don't know that I would frame it as insulting my intelligence, but I can't do it.
Let me ask you another way. Well, yeah, you can't do it.
Yeah.
Okay.
There's not enough specificity to do this.
Now, if we don't know what we're doing
Right
on
now.
mortgage-backed securities for which you can really get a good value, I understand the first plan had limited us to mortgage-backed securities. The next says anything he wants to buy. Is there any reason to go past mortgage-based securities?
Well, the first plan didn't quite limit it to mortgage-backed securities. It limited it to mortgage-related assets, which can be a whole array of different things.
Is there anything reason to go past that?
I think the argument to go past it would come back to the question Mr. Blumenauer asked, which is we don't know what will implode next, and if you want to do this on a one-off kind of give the Secretary authority to go fight fires wherever they may occur, the fires may occur outside of mortgage-related assets.
Generally accepted accounting principles on book value. What should the book value on a corporate books have good faith value, purchase price, or what?
I think in general, and there's some controversy over this, but in general, there are benefits to marking to market. So book value doesn't always reflect market values. There have been concerns that have been raised about marking to market during particularly volatile financial market times like we are experiencing today.
Okay, so it's not always, it's kind of artistic is what you're saying. You indicated that if liquidity alone is the problem, those companies that have good assets for their liabilities, if that's all we're solving, we could do this, we could solve the liquidity problem without much net cost to the government, but solving people's insolvency problem where they're actually bankrupt ought to be a separate question.
That's correct.
Okay, on this reverse auction, it seems to me that if nobody knows down deep what's behind these things, if the seller did a little due diligence and figured it out, we would be buying blind, they would be selling with knowledge. Isn't that a recipe for getting ripped off?
Yes, if what the sellers are offering you are different things. If instead, and this is what at least part of the Treasury program is likely to entail, if instead you have different owners of the same thing, so you have some given cash flow that's split among 100 different institutions, if they're the ones bidding, you're only bidding on their shares, then you don't have that problem.
Well, you only have the problem to the extent that they know what they've got, and you're trusting them to try to bid against each other to try to fair value, and you hope they know what it's worth, and you'd come out. But isn't a due diligence reasonable yield to maturity? Isn't knowing that number essential to know what you're buying?
Again, it depends on the context. More confidence in the scenario we just discussed, that the competitive bidding process would give you the best guess of what that underlying value is. In other cases where they're offering different things, then yeah, you have this problem that you have to, in a sense, value each individual asset that people are offering to sell you.
So you know what you're buying.
So you know what you're buying.
Isn't that a good idea to know what you're buying?
In general, it's a good idea to know what you're buying if you want to avoid overpaying.
Your whole analysis is such that if you don't overpay, you will have at most a wash and at best a profit. If you overpay, you could be getting ripped off, and we're going to spend $700 billion without knowing what we're doing.
And I think one concern is it's not clear the degree to which we're trying to address, we're trying to overpay, and in fact some of the comments that were made yesterday suggest perhaps we want to overpay to provide support to financial institutions versus just simply trying to restore liquidity to markets, which need not imply any significant overpayment. And I think it is important to figure out which one we're trying to do.
And it'd be nice to know what we're doing before we spend $700 billion doing it.
Thank you, Mr. Chairman. Let me thank you for holding this hearing. Dr. Orszag, thank you for being here. Let me go back to a little more personal on Main Street on this with the budget implications. Friday night, I was at the Boosters Club banquet with a bunch of folks, talked to a builder. He's down to 2 people from 30.
Mm-hmm.
Talked to bankers over the last several days with regional banks. They're no longer making any loans.
Mm-hmm.
Because they concerned they're not moving, as you said earlier, they're not moving money from bank to bank. And I guess the other part of it is many of us feel like we're riding the back of the tiger and we're not sure where the tiger's headed. And we don't want to hop off, but we're afraid to, we just feel like we're riding without a roadmap. So my question is, I was in business for 19 years. And you touched on it earlier, and I wanted to go back to that because I think what we're doing, the effects or where we get to. Businesses not only buy money for raw materials, they got to borrow money for inventory, for storage in some cases, for that equipment or product that's moving and that hadn't come back to pay their salaries. Now, it is now September, mid-September. A lot of businesses have already booked their purchases for the holiday seasons or in the process of it, needing money to pay for that inventory with anticipation of the holidays. Talk to us, if you will, about the impact on the budget on this issue. If that seizes up, the inventory doesn't move, they can't get it. Some of it may be there, but the consumer has a problem with their personal finances, and then all of a sudden we have a horrible holiday season that bleeds into a new budget year.
That is exactly the scenario that is of most concern in terms of real people and the downward spiral that would follow. I'd note one small silver lining, which is not to downplay the seriousness of the problems that we face, but it is the case that corporations as a whole have built up their cash reserves, in part because they're coming off of many years of relatively high profits, and in part because there were indications that credit markets may start experiencing difficulties. So that does provide them a bit of wiggle room for some period of time to draw down those cash reserves while other sources of liquidity are drying up. But ultimately, if the financial market problems are perpetuated, they will become a very severe constraint and cause problems not just for the federal budget, but for the economy as a whole.
Well, let me go a step further because you're talking about the large corporate entity.
Yeah.
In a lot of parts of this country, it is the small businesses that are.
They're not sitting, they tend not to be sitting on as much cash.
Yeah, and they're going to the banks
Right.
monthly, bi-monthly, in some cases even weekly to move it through. And that is affecting Main Street big time. When that gets tightened up, then the whole process affects the big corporations. They may be sitting on cash, but they don't buy their product and it doesn't move. And now we've got counties and cities going through tax reevaluations with the housing market going down. That's going to have a significant impact on the ability of the local institutions of government to provide the services that they need to provide. And that ultimately impact our budget again, correct?
Yes, again, we will, it is highly desirable to avoid the downward spiral that could follow from failing to address this crisis of confidence in financial markets.
It seems to me, Mr. Chairman, the challenge we face is trying to get something right, you know, and understanding where we are. I thank you very much, and I yield back.
Yeah, the legislation requires that CBO would report to the Congress on a quarterly basis on the net cost of this program to the federal government. For us to do that well, given the wide array of assets that are likely to be involved in the program and the kind of modeling that was discussed earlier, we need some more people who are expert at that. We may also be given a huge array of data on all of the individual assets, and we need some capacity to be able to process that data, which we currently lack. Or another way of putting it is, it's obviously up to you in terms of whether you want us to play this role, but if you want that kind of reporting, regular reporting from us on this complicated program, we don't currently have the resources to do it.
We think we do want that role fulfilled, and particularly by CBO, because we have the closest relationship with you. So thank you for putting that on the record. Now, Mr. Baird.
I want to thank Mr. Orszag. He's always on the mark, tells us what he knows, what he doesn't know, and is tremendously informative. My friend, Mr. Blumenauer from Oregon, raised the issue of what might be on the horizon. For some time, I've personally been greatly concerned about the ARM reset issue. A great number of Americans took out ARMs or other devices, and instead of lowering their debt equity ratio, increased it. And the ads were come-ons to do that. Is anybody giving some thought to what happens as millions of Americans who at current have a net negative savings rate suddenly see an ARM kick in to $500 to $1,000 a month more than their current mortgage, and what that has? Is that the next wave that we seem to always be behind the waves? Are people looking at that, and how can we get ahead of that?
As you may know, and I'm sure you do, that was a significant concern a year or 2 years ago as we were looking into the eye of this. Those concerns, while they're still there to some degree, have attenuated somewhat, in part because the Federal Reserve has acted so aggressively to reduce interest rates that the resets aren't as severe as many people feared, let's say 2 years ago. So it's still there, but I think it doesn't loom as large as a concern as it did a couple years ago, in part because overall interest rates, especially on the short-term end of things, have declined so dramatically.
The second question is, if you look at how we got into this, it is because many, in a nutshell, many firms vastly over-leveraged. They had much more outstanding debt than they had collateral to cover it. To some extent, that's analogous to what the federal government is doing. We've got $9.4 trillion debt, rapidly hitting the 9.5, it looks like, and maybe more. Some of us feel we ought to pay for this. During the last 8 years, the administration has not once come to this Congress and said, this is how we're going to pay for something. And some of us feel that the people who got vast wealth and income out of creating the conditions that now are plaguing our country ought to be the ones who pay for it. Not average guy on Main Street and back home who's been paying his taxes, paying his mortgage, going to work every day, but the guys who are pulling in $25 million golden parachutes. What would be can you give us a ballpark estimate of how much revenue could be generated if we just put a modest tax increase on people with, let's say, $2 million a year plus income? I seem to remember a few months back we were looking at funding the GI Bill. My recollection is a 1/2 of 1% tax increase on people with incomes over $1 million or so a year. Beyond the million generated $50 billion over 5 years. A ballpark, my memory may be wrong, but how much can we generate from even a modest increase on the people who are most well-to-do, so we don't pass this burden on the average taxpayer?
Let me say two things. First, again, to the extent that you're purchasing assets at fair prices, there is no, in a sense, that pays for itself, or there is no net expected cost. When you're subsidizing the purchases, when you're overpaying and thereby providing a subsidy to financial institutions, that's where the expected cost comes in. There are a variety of ways that if you wanted to pay for it, you could. High-end income taxation is one possibility. I don't remember the exact numbers which came from the Joint Committee on Taxation, but we can get them to you.
The problem some of us have is you read the articles and it says the plan from Treasury is to rescue these companies by buying their bad debt. Guy comes up to me and says, hey, buddy, want to buy some bad debt? I'm going to say, no, I'd rather buy some good debt,
Yeah.
thank you very much. So on the one hand, we're told, oh, this won't cost very much because you're buying real assets. On the other hand, we're told, but you're buying the bad real assets.
And the key thing is, what is the price at which you're buying that bad debt? If someone comes up to you and says, I have this bad loan and I'm going to give you a huge discount, it might be worth it to you. And so that's why I was emphasizing so much, are we overpaying or not? How are those prices being determined? It's not necessarily the bad debt itself, but rather the price that you're paying for the bad debt that becomes the issue.
But the other two key questions are, who's going to benefit from me buying it? And why should I buy something to help somebody out? They're not just coming to say, buy the bad debt. They're saying, buy the bad debt. So all these CEOs who made so much money driving these companies into the dirt, and they justified these big incomes on, well, we have a lot of responsibility. Well, they botched their responsibility, and the average taxpayer says to me, why should I bail them out? Thank you, gentlemen.
Ms. Capser.
Thank you, Mr. Chairman, very much. Thank you for allowing me to meet my responsibilities as a member of this committee in Congress. Dr. Orszag, thank you so much for coming today. My goal is prosperity and jobs on main streets across this country, with a power shift, an economic power shift from Wall Street and this city of Washington back to Main Street. And I'm asking myself how to do it as we face this situation. The very best book that I have read that puts this into perspective is by Kevin Phillips, chapters 8 and 9 of his book, American Theocracy. I'm going to ask the chairman to place chapters 8 and 9 in the record. The first called Borrowed Prosperity and the Financialization of the U.S. Economy, and chapter 9, Debt. I believe we find ourselves in the predicament that we do because there has been a tremendous power shift from Main Street to Wall Street and to this city of Washington. It's too concentrated and it's too intangible. I support reform of our financial structure, reform before any taxpayer support goes out the door, to especially the financial services sector. FDR figured it out. We should too. And my feeling is we shouldn't adjourn and go home to campaign until we meet our responsibilities to the American people. Now let me put this in some perspective. About a century ago, Britain, as it continued to decline in power, its colonial secretary said, banking is not the creator of our prosperity, but the creation of it. He understood the difference between money and wealth, and that trading abstract financial instruments was different than the production of real tangible goods and services that create real tangible wealth. Now, Phillips, on page 266 of this excellent book, states, by 2004, financial firms in our country boasted nearly 40% of all U.S. profits, up from just 6% in 1980 and 11% in 1990, while the manufacturing sector fell from over 60% of profits down to less than 10. Part of that is because this very financial sector has been outsourcing our jobs all over creation and outsourcing the purchase of our bonds to foreign countries. So we're losing control as our economy is being globalized. My question is whether propping up paper money is the best expenditure of our nation if our goal is prosperity, jobs, and tangible real wealth on every main street across our country. My purpose is to create wealth, not just paper money. And let me just finally say that if we look at the 1980s, and I served here back then, after the Resolution Trust Corporation was set up, after the imprudent behavior of the banking sector, rather than tightening controls and returning power to Main Street, we did exactly the reverse. The imprudent institutions were actually allowed to become more imprudent. Investment houses created money without underlying assets, and the old time-honored principles of character and collectability and collateral at the local level, where we had local savings banks with deposits, with passbooks that paid interest, and then they made loans. We totally reversed that, and we changed loans to bonds and securitized them into this highly debt-structured market, and we saw this huge power shift from Main Street to Wall Street, and now they're coming to us and saying, oh, bail us out, when in fact, I'm saying, I'm not sure the financial sector is the sector I want to bail out. I want to produce real money. We did interstate banking. I voted no on that. Again, to create these mega giants that move power and money elsewhere and decision-making elsewhere with imprudent standards. In 1994, they took the name Banking Committee off the committee in this very House, and they changed it to Financial Services to empower the very folks that did this to us. In 1999, I got many examples. Glass-Steagall was removed. The historic separation between banking, commerce, and insurance was removed. And my question really is, as we do this, how do we restructure the bigger picture to return financial power and responsibility to Main Street and to recreate the institutions Franklin Delano Roosevelt understood well? Local community banks with prudent lending standards. He had the Home Ownership Loan Corporation to restructure the bad debt, which is what they're asking us to do now. Why can't we do that? Why do we just have to bail out those who created phony money?
Well, I think, again, there are two issues. One is the immediate problems that the crisis of confidence in financial markets seems to entail, and the second is the regulatory structure on a going forward basis. In my opinion, for whatever it's worth, I'm not sure that we have the time to make the underlying regulatory changes, whether they're of the kind that you favor or others of your colleagues favor, before addressing the concerns surrounding the collapse of confidence in the financial markets. Especially, by the way,
may I just say this, Mr. Chairman, and that is what troubles me about this whole discussion, because I hear these pundits on TV, these guys that come up over to the Senate from the administration, they always say, we want the money before the reform. I say the reverse. Roosevelt figured it out under much more difficult conditions, so should we. I thank you, Dr. Orszag.
Ms.
Thank you, Mr.
Kaplan.
Chairman.
Mr. Boyd, I'm prepared to miss the vote so that, Mr. Boyd, you can go ahead and put your questions. I think it's a procedural vote,
Right.
and if you'd like to do the same, we'll proceed.
All right. I'd like to proceed, Mr. Chairman. Thank you.
Mr. Allen, Mr. Boyd, you're recognized.
Dr. Orszag, thank you for your service, and I apologize for being late, too. So if I ask something that you've already answered, please indulge me and forgive me. And I want to start by saying that I'm extreme, and sort of spin off what Ms. Kaptur said, I'm extremely skeptical about whether this is the right thing to do. That skepticism, I think, comes from the fact that I'm concerned that we may be treating the symptom and not the underlying cause for the problem. But I want your counsel and advice in one specific area. And I want to talk about the devaluation of the dollar and the role that's played in all of this. I don't think it's complicated that most economists would tell you that the devaluation of the dollar, the primary cause is government deficit spending. And what is, if in this proposal, what role or what will that do in terms of the value of the dollar worldwide?
Well, again, let's back up. The dollar has been, actually, frankly, even though this may sound ironic, one of the silver linings, or one of the things that has been going relatively well during the economic challenges that we've been facing over the past year or two, is that the depreciation of the dollar, which had to occur, has been going relatively smoothly. In other words, the foreign exchange markets have not experienced the same kind of crisis that some of our overnight lending markets are now experiencing. So that decline in the dollar, which has had to occur because we have been borrowing an unsustainable amount of funds from abroad, has occurred relatively smoothly, and everything's a relative statement. What will happen from this kind of legislation? It depends on, again, the degree to which market participants believe we're overpaying for the assets that we're obtaining. To the degree that we're overpaying, that is a deterioration in the underlying condition, fiscal condition of the federal government, and the same forces that then can lead to concerns about both national saving and all the other things that feed into the normal dynamic of potential depreciation could apply. To the extent we're just simply purchasing assets that are worth what we're paying for them, at least in a purely rational way, that really shouldn't have any significant effect on the U.S. dollar. Whether financial markets, because of psychological reasons or others, perceive it that way is an entirely different question. That's a sort of a textbook answer.
With the existing underlying reasons for this, and a lot of folks have talked about, Mr. Kaptur talked about the abstract financial instruments, the derivatives, all of that, which obviously play a role in all of this. With the infusion of $700 billion of money, I assume most of it will be borrowed, and that gets rolled numerous times. Does that exacerbate the devaluation of the dollar problem around the world?
Well, what I would say is we have not experienced, and I don't anticipate experiencing, any problems raising the $700 billion or rolling it over regularly. But just like financial market institutions that had gotten in the habit and gotten used to regularly rolling over their short-term obligations, one problem with a higher outstanding stock of government debt, which does have to get rolled over, is if in the future, for whatever reason, there were confidence problems or other difficulties in the Treasury market, having a higher outstanding stock of government debt that has to be rolled over would exacerbate the problems that we would face.
Okay. All right. Can you help me with my extreme skepticism about whether this is the right thing to do? I mean,
Yeah.
John Spratt, Marcy Kaptur, and myself, others are certainly lived with parents who came out of the Depression, and our lives were shaped at a very young age, obviously by that experience, their experience, and it's something that we thought we had put tools in place to keep from happening again. So, can you calm my extreme skepticism?
Well, let me say
about
two things.
What we should do?
One important contributor to the Great Depression was policymakers who not only failed to act, but actually, in some sense, often did counterproductive things. And I think, luckily, there is at least a mentality now that will avoid some of those the worst problems associated with policy in the late 1920s and early 1930s. So that's the first thing. The second thing is, fundamentally, you're asking, will the $700 billion work? And I don't know the answer to that because, again, it comes back to this question that fundamentally, or a fundamental driver of what's happening is a collapse of confidence. Whether the $700 billion restores confidence or not, I don't know. And by the way, it's hard to know even without knowing. I mean, again, we don't even know how the program will be implemented with any granularity. So I think it is an open question. But I also think that's a separate question from whether or not you should do it. It may not work, but if you do nothing, it definitely won't work. So what you do is up to you, but I think at this point, unfortunately, especially having created the expectation in financial markets that you'll do something, doing nothing would likely be a very serious mistake.
Mr. Chairman, may I ask one last short question? Great debate here about the $700 billion infusion and versus the regulatory reforms, oversight reforms, those kinds of things. If you were sitting in Congress, would you vote to extend the money without doing the other first?
Am I allowed to say, thank goodness I'm not sitting in Congress? Look, I mean, you face a difficult situation in the sense that time is of the essence here, and I think it has to be correct that it would be nice to be able to do, not give dessert before you've eaten your vegetables. But the question is whether you have the time to do that, and that's obviously an internal dynamic that I shouldn't comment.
Would the gentleman yield on that?
Certainly.
Mr. Chairman, I don't know if this is within the purview of our committee, but Dr. Orszag is so excellent, and his staff and your staff, Tom. Would it be possible for us just to have a brown bag lunch sometime and look back at the 1930s, what was done quickly in order to stem the hemorrhage?
Sure, we can do that. We can look back to the 1980s and what was done with Lockheed and Chrysler and Penn Central. In all of those cases, they're somewhat success stories because the loans and guarantees were ultimately paid, and warranties, warrants, at least in the case of Chrysler, resulted in a profit.
Thank you, Mr. Chairman. You know, one of the characteristics of the three that you've mentioned is they all had tangible hard assets.
Yeah,
What we're
it
dealing
sure
with
did.
here is phony money. And
Well, that's a very
but
good point. When
that
you all were
discussion
getting
is
to
one I
vote.
would love to have in more depth, and I have the highest respect for you. Thank you.
If we stop now, hustle to the floor, we may still make the vote. Alan?
I have one
last
quick question. Did you say, did I hear you, understand you just say you were advocating for a reverse auction process if we go through this?
I don't advocate for anything, but if you want to obtain a fair price for what you're buying, limiting things to reverse auctions on a given cash flow that are that's distributed across many potential owners accomplishes that objective.
Thank you.
Other asset classes and other ways of doing it doesn't.
Thank you.
Dr. Orszag, as always, thank you very much. And particularly in this case, your testimony was excellent help to the committee. We very much appreciate it.